Peter Lynch is making quite the name for himself in the finance world as one of the smartest investors up to date. He's got a return of 29.2% while managing the Magellan Fund, which was also named one of the top performing mutual funds in the world. So now we will be breaking down Peter Lynch's advice from one of his interviews. He talks about high stock market prices and what to do with them. But before that, who exactly is Peter Lynch? So besides being one of the smartest investors, he is one of Wall Street's biggest money managers. We now know that he runs the Fidelity's Magellan Fund from 77 to 90. After 13 years of him behind the wheel, it was up an astonishing 2,700%, making it the world's largest mutual fund. Currently, he is still sitting on the board of trustees for the Delta Group and is also the vice chairman of Fidelity Management. So, what does he know? Welcome to Financial Market TV. If you're new to the channel and enjoy content like this, hit that subscribe button and the notification bell. Also, please don't hesitate to share your comments down below and give this video a like. Let's get started. So, Peter Lynch explains the situation of the US economy. During that time, the market was roughly at 4,000. Then it started shooting up around 8,300 by the next couple months. For Lynch, he stated that it was actually healthy to back off a few numbers rather than go for the long shot sometimes. He compared this with Japan. Japan's market started with 5,000 at a certain point, jumping to 15,000. It was standing at a fair price by then. However, it continued to increase until it reached 40,000. This resulted in highly inflated real estate, people overspending, leaving Japan to be in a recession for 5 to 6 years just because their market was actually too high. Whenever a market gets too high, you're discounting earnings to around 7 or 10 years out because everything is basically overpriced. Since World War II, the market has been sold between 10 times earnings and 20 times earnings. Once you look at the Dow Jones or the S&P fund, you add up all the companies and get the earnings, you might say they are fairly relative. For example, McDonald's earnings have been doing incredibly during the last 30 years or so. With that, there is a direct relationship. The earnings of the SP 500 have been between the range of 10 and 20. We were almost reaching beyond 20, which is the highest point a PE range should be fairly, where there has only been a few times where it has gone beyond the 20 point, usually by the time the inflation would have dropped to zero. In the 1960s, that's when inflation was zero, and indeed the S&P 500 went past 20. Currently, we have a low inflation rate, so when you usually subtract the inflation from 20, you get the P of the market, and the ratio has been pretty good so far. In the early 80s, the inflation was at 12%, or with an 8 or 9 P in the market. According to Peter, he never thought he'd wish for the market to not go up. It didn't seem to make sense before, but it's clearer now. If ever the market went up to 16,000 tomorrow, there would be earnings behind companies. In addition, stock market prices ought to be relative to earnings, earnings performance, and earnings potential. So was a decline in the market actually reasonable, especially if it was overvalued at the time? Apparently, letting it off when it's at a high point can be beneficial. Lynch believes it would be fairly priced in that case, maybe for big companies or even small enterprises. There have been around 3,000 companies going public in the last 4 years. Several companies have gone down dramatically, so that's a sort of feasible for average people in the stock shop. Some people are aware of certain public companies. Some brands seem very attractive, but no one exactly follows them. Lynch advises that you go for companies with union, companies who are in trouble, or even the underrated companies. You have to look at 20 to pinpoint a good stock. It's not like the mall and instantly finding what you're looking for. So once you think a stock seems worthy, you still have to go through a series of steps to determine its true value. This is like how people are careful when they buy products. You buy a toaster or a TV or even pick out what to eat. You still do some research to see if you're spending your money on what is worth it. But a lot of times, especially small investors, tend to buy stocks the first time they hear about it. You hear the next guy boast about his recent hot stock purchase and they blow $5,000 the next day. You know how it gets very cold in a winter and you get memories of it, so somehow you feel when winter is coming next. Well, it can be applied to the stock market. So whatever happened to other countries should be a reminder or at least a warning that something is going to happen. Or better yet, you get how profits can actually go down. In addition to Lynch's interview, he was asked if other countries can affect the US or market as a whole. He says it probably does. So how does this happen? Those Asian countries have been growing at a double-digit pace, and suddenly they go under leverage due to bank problems or they're overfinanced. In fact, people start talking about how China could be going into a recession, and this became a wake-up call that there might be something going on. Although it did not have much of a big impact in the US economy itself, when Mexico went down, the situation would have been a bigger deal versus the economy of Thailand or the Philippines. This is because they are more geographically linked and are a big consumer of the US market. Naturally, Latin America's economy greatly affects the United States at some point. One thing you try to do though is out of all the public companies that you can see, there's this one company that you like. Let's say it's because of their fundamentals. Their earnings are doing well, there's little to no competition, then all of a sudden their stocks fall from 40 to 30 because of the decline. You could have seen this as an opportunity to buy it. Sure. During the decline, some companies you might think have been overpriced from 60 to 50, which seems like a good deal. So you probably would go for the companies that you initially liked anyway. You don't go for the ones who were highly priced and got cut to a fairly priced rate. It's best to just buy the ones who were fairly priced from the beginning. So was Peter Lynch going to go on a buying spree during the market decline? No. As a matter of fact, he would have been researching harder, looking for companies that are the same story. Despite a decline or even a recession, we have companies that still stand their ground without much changes. Those are the kind of companies that Peter would be aiming to buy. Let's say we have a company that you think would be earning big in the future, and if it's already discounted and selling huge multiples, no doubt this will work. But when it all goes and stays only even, so the question you should be asking is, if I'm right, how much am I going to make? If I'm wrong, how much am I going to lose? We call that risk-reward ratio. In a stock shop, you should be aiming to be doubling or even tripling your money if you bet on the right ones. If you're wrong, let's hope you lose only around 30 to 40%, and that right there is a favorable ratio. You need to have an edge or at least be aware of a company's edge. For example, a cement company goes from being underrated to a bit average to fairly good. At this trajectory, you know the stocks are going to go up. That's the industry you know and can trust. What if you also worked in a restaurant over the past couple years? Then we assume you would have known Taco Bell, you would have known Pizza Hut, you would have known and seen Chili's. You would have been well aware that these companies are doing well in that certain industry. So you go ahead, buy those stocks rather than going for biotech companies which you know nothing about. This works to your advantage since you would be early in the ball game. So take the chance to buy from companies that you know instead of going out and buying something unfamiliar. People have this tendency to always buy and buy, but all you actually need is a few good stocks. All you need is data. What if you're looking at companies that are doing poorly? So naturally you buy the one that has a $3 million in cash instead of the one that is on the road to bankruptcy. A lot of companies are selling $2 to $3 a share, but they might be losing $10 million. You just have to be smart enough to look up the balance sheet and see whether the company you would want to buy is headed the right direction. At the same time, Peter Lynch advises people to spend both on stocks and mutual funds. You could spend on mutual funds occasionally while also looking to buy stocks that you think would make a difference in your life, or at least in your portfolio, and namely an industry that you know something about. Local companies also work well since you could experience them firsthand. Peter shares an anecdote where he stayed at a motel and got a few comments from his competitors. Eventually, he wound up buying their stocks. In a way, there's more to just watching data to be able to get information. Don't throw it away. Peter also shared, even if I hadn't made much money, I'd like to see people do a better job. Obviously, he wants to see a lot of investors follow in his footsteps, maybe even outdoing the success he's achieved. He likes sharing what he can so he can help in improving the investing habits of America. In a way, he also said that if you're not able to or ready to invest properly, don't do it. So what advice does he have for the future market of our investors? Again, it's no guarantee. He says that the next 6,000 or 14,000 or even 20,000 points could be up or down. It's pretty futile to try and guess it. What you could rely on is corporate profits are going to be up every few years. New companies will come along, so you got to keep your eyes peeled. So Lynch keeps his optimism about the future of the American economy. For earnings potential, most companies would be doing well in the long run. But don't forget, we've had 9 recessions since World War II. It's a given that we would have more in the future as well. And guess what? No one will tell you when this is going to happen. All of a sudden, you might notice orders slowing down, prices are getting more competitive, earnings are down. Usually, you just need to find those warnings. They say we are going to have a recession on, but it still hasn't happened yet. So let's not get too carried away with worrying. Now let's wrap up the main points from Lynch's interview. One of the first things that they discuss in the interview is the market PE ratio. Once you see the PE ratio tip over 20, that's when you need to be on high alert. Now, that is the market of the United States right now. It is above the 20 mark. And what does that tell you? Prices are high. So how do we invest in this kind of market condition? Let's recall Lynch's interview. First, buy good quality businesses that are strong in the market competition. These are the ones that are going to survive a crash that could happen. Second, check if they have strong and stable balance sheets, and it's also best to make sure they are still holding cash in case of emergency. Third, be knowledgeable about the company you own. You wouldn't want to buy a local business knowing absolutely nothing about it. Again, what you know will grow. And of course, good times don't last forever. Be always prepared for a possible market crash. Like what Peter mentioned, the market could go up, but it can also come down. So keep yourself recharged financially and of course emotionally. We know it's not easy, but that's a good thing because most people wouldn't be in either. So if you are, you win. Thanks for watching the whole video. Again, if you're new and like this type of content, subscribe to our channel. And don't forget to leave a comment down below and hit that like button. Also, click on the notification bell to get updated on our weekly uploads. See you in the next video.